The last year and a half has been nothing but good news for the stock market. The stock market has been rallying at record speeds, and Wall Street sees everything as good news, even if it's not so good news. But the problem is nothing can go straight up forever because we have the stock market that's soaring while we have an economy that's slowing. What's up, everybody? I am Jaspreet Singh from theminority-mindset.com, where money minds rethink rich. The stock market is not the same thing as the economy. The stock market is the place where people go bet on the economy. They put their money where they believe in companies because they believe in the future of the economy, and the economy is the actual companies. This is where people are going to work. These are the businesses that are making money, and so they're related, but they're not completely the same. Everybody is a financial genius in the bull market because everything you touch goes up, so it looks like you know everything about investing your money. But the real test of financial intelligence is what happens when things go down, because the reality is nothing can go straight up. Not even stocks. I mean, we're in a very weird situation because in 2020, when the pandemic hit, we entered the worst recession since the Great Depression. The stock market started collapsing, and as soon as that happened, the Federal Reserve Bank came out and they unleashed the money printer, and then they started propping up the markets. They started buying up assets, they started flooding the markets, and this caused the stock market to go up, and it caused the stock market to rally, and it is continuing to rally. Then we started hearing about the economy opening back up, businesses opening back up, people going back to work. This was great news for the market because now finally things are going back to normal. This pandemic is starting to end. People can start to work again. Companies can earn money. People can earn money and people can spend. But then what we're starting to see is that the economy is not growing as fast as we would like, even though we have all this cheap debt, even though we had all the stimulus money enter our economic circulation. Our economy is still not growing very fast. We're still not where we were before the pandemic, yet our stock market continues to soar. This is great news for investors because if you own any stocks, chances are you've seen huge profits. I know my portfolio has been seeing a lot of gains because we've seen a lot of money enter the markets, and this is propped up the price of stocks. So this is great news if you have money in the market, but that doesn't mean that anything can go straight up. You have to understand that nothing can go straight up forever. The reason why I keep emphasizing that is because we have a massive boom of new traders and investors entering the market. The pandemic and this 2020 recession brought in a massive amount of new traders. Like Robinhood has seen the biggest growth of their platform in the pandemic and during the 2020/2021 crash, because this brought in so many new people who want to trade and invest their money in the market, which is good news. But you have to also be cautious because all of these traders and investors are coming in and all they've seen is an upward market. But what you have to remember is that you were going to see ups and downs, and you need to know how to weather the storm, and you need to understand what's really going on in the market, because as we start to see the money printing start to go away, as the Federal Reserve Bank starts to stop their money printer, because right now they're still injecting about $120 billion into the market every single month. This is money going directly into institutions to help prop up the markets, to keep people confident in the stock market. And so you have to be aware of what's going on, because if things start to slow down in the economy even more and it trickles into the stock market, because you have to think if the economy continues to slow down and we're not seeing growth in the economy, you're gonna see it trickle into the stock market. You need to know exactly what could potentially cause that. That way you can make smart decisions with your money. So let's jump right into it, because there are three things that can slow down the stock market rally, which I want you to be aware of. But before we get into these three things, I need you to do me a quick favor and smash the thumbs up button below. And if you're looking for some extra guac, meaning some extra minority mindset, you can check out some of our other newer Minority Mindset YouTube channels. We have the Minority Mindset News channel, where Nate puts out new finance and business videos every single day. So if you're trying to stay updated on what's going on, check out the news channel. We have Minority Mindset Clips channel, which are shorter Minority Mindset videos. So if you're looking for videos that are 8 to 12 minutes long, check out our Minority Mindset Clips channel. These are videos of me. And then we have the Minority Mindset Spanish channel. So if you're looking for our content in Spanish for our Latin speaking countries and our Spanish speakers, you can check out our Minority Mindset Spanish channel. I'll put the links to these channels in the description below. The first issue that can really cause a stock market rally to slow down is if more people start to get worried about the strength of the dollar. Everybody's worried about inflation. That's why you're seeing a lot of people now wanting to move their cash to other assets, things like stocks, real estate, Bitcoin, gold. So people have been moving their money into stocks because they're worried about inflation. But if people really start to get worried about the dollar and the long-term health of the dollar, then you might see people move their money out of stocks. Here's what that means. In 2020 and into 2021, you saw a lot of people spending money that they didn't work to earn. They got this money through the help of the government. Now, the government didn't have money just laying around to pay for everything, right? The government has national debt because they spend more money than they have. So the way that they fund these stimulus programs, and it's not just people. You see the same thing happening with corporations, but it's easier to understand with people. So the government now has to print this money out of thin air, and then they give this money to people. Now, when the government does that, they create new dollars out of thin air, and this creates more inflation because now the value of each dollar goes down. But now let's take a step back and understand what this means. People are earning dollars that they didn't have to work to earn, and these dollars are created out of thin air. Then people take these dollars and they go shopping. They go and spend this money. And this money goes to a store who's creating their products overseas. So this money is now being used to buy products made overseas, and now you have these countries overseas that are creating products, and the only reason they're willing to create these products is because they're willing to accept our dollars that are created out of thin air to create these products. So these companies overseas are now taking our dollars created out of thin air, they're creating products and sending us the products. If these companies and countries overseas start to wonder, wait, what is the real value of this dollar? Does this dollar really have the value that we think it does? And then they start to say, you know what, either we're going to want more dollars or we don't want this dollar. Then we're going to have real problems, because then people are going to say, wait, I want to be able to buy these products, but you're not willing to sell me these products at this price. I have to pay you 2 times more. Anytime you start to see these big inflationary worries, what you see happen is you see investors sell their stocks and then they move their money to new assets, things like gold, things like land, and nowadays things like cryptocurrency. Or you might also see the investors sell their stocks to buy companies of emerging markets, so countries that are up and coming, that where they're not just reliant on the dollar. This is a pretty unique threat because this is not something that anyone had to ever think about before, but now investors are really starting to think about this because they're worried about what could potentially happen with the dollar if we continue to spend more money than we bring in. So if the government keeps spending way more money and they don't have the tax revenue to pay for this, and they just keep printing money to pay for all of their expenses, if countries around the world and people start to question the real value of the dollar, well, then that could put a lot of downward pressure on the dollar, which could ultimately hurt stocks. Now, you might be thinking, wait, Jaspreet, if the dollar becomes weaker because we see more inflation, wouldn't that mean that stock prices would go up? Well, it depends. If a company is dependent upon the dollar because they transact with the dollar, and now this dollar becomes less valuable, now this company would in essence become less valuable because everything they own is measured in dollars. It kind of like has a tipping point, because in general, inflation can be good for stocks, because now when the prices of things go up because the dollar gets valued, you own shares of the companies that are now selling the products at higher prices. And it's not necessarily a higher price, it's just that the value of the dollar, the currency, is lower, and so the company has to sell it for a higher price. And if you own the company, then you're benefiting because now the value of your stock goes up. But if you start to see too much inflation because of worries about the actual value or strength of the dollar, then that can be too much, which can cause it to come down. And this brings me to the second thing that can slow down the stock market, which is an economic slowdown. This is probably the most obvious thing because the stock market is supposed to work kind of in correlation with the economy, but it doesn't always work that way. Because if the economy slows, then you might see the stock market continue to go up if people believe that the economy will start to grow in the future. But if the economy is growing slower than expected, this can hurt expectations, which can cause people to now pull their money out of the stock market because they're worried about the future strength of the economy. Our economy is having some serious issues. I mean, companies are struggling sourcing products because of supply chain issues. Companies are having a tough time finding labor because of labor shortages. And companies are having a tough time figuring out what to sell their products at because either they can't source their products or because of inflationary pressures, which are forcing them to sell products at higher prices. And if people cannot afford the products, then they won't be able to sell their products, which ultimately hurts the company. But we also have a less talked about issue, which is really starting to become a problem, which is the trade deficit. This means that the United States is now exporting way less than what they are importing, and we are breaking new record highs with our trade deficit. This trade deficit started to become an issue towards the summer of 2021 because we started breaking new record highs for trade deficits, and we were doing this month after month. And then in August of 2021, it really started to get bad when our trade deficit was getting way worse than expected. And then come September of 2021, our trade deficit got even more worse than expected. What this means is we are relying on other countries more than we're relying on our own to create products because we are importing way more products than we're exporting out of the United States. So it's a trade deficit. Now, some people might say, say at this point that, oh, this is because of the supply chain bottlenecks that we have going on. We're not able to get products in or out of the United States. But if that was the case, our trade deficit would say that we are exporting more than we're importing because our ports are so clogged that we can't bring things into the United States. But that's not what it says. It's saying that we are importing way more than what we are exporting, which is why we're seeing this massive trade deficit at levels that we have never seen before. So why does this matter, right? Because I mean, if we can produce products cheaper in China and Vietnam and India and other places overseas, shouldn't we just pay them less money over there, that way we can get the products cheap and then bring them into the United States? And in theory, yeah, you're right, because if we can make the products cheaper over there, why would you want to overpay to get it made in the United States? Sure, we can create jobs in the United States, but if you're looking at this from an economic level, if you can make everything cheaper over there and you can buy things overseas, then how is that bad for us? Well, the problem that this is kind of indicating is that we are not really producing products. And because we're not really producing products, we don't have things to export, but we're relying on all these other countries overseas to create products for us, which means we are more reliant on them than they are on us. And the reason that we're able to pay for all these products overseas is, again, because of our dollar. They believe and trust that our dollar has value. But if that ever gets challenged, now we are in big trouble, because now we're trying to buy all these products because we're reliant on the rest of the world to produce products for us. We're hoping and praying that they will continue to accept the dollar as payments for all the products that we need, but if they don't, now we're in trouble because we're reliant on the rest of the world to produce all of our products, and now we don't have a way to pay them because they don't want the dollar anymore or because they want more dollars, and now we're not producing enough to create income within the United States to send this money out. So we need products created by the rest of the world more than they need products created by us, and this is only able to sustain as long as people continue to value our dollar. And then we have a surprise, economic slowdown because the country is not growing fast enough economically. And everybody thought that, hey, our pandemic is over, people have this pent-up demand, they have all this extra cash, they're gonna go spend, and our economy is gonna start growing and it's gonna start booming. But our economy is not growing as fast as we would like, and in fact, we're seeing the economy actually start to cool down. It's slowing down, which means that now we're running into a tough issue because the government thought that they could just stimulate our way out of this pandemic to get our economy roaring again, but it's not working fast enough because our economy is still slow and it's actually slowing down. Even Amazon's starting to get worried because they're saying that spending is slowing down and they don't know when it's going to pick back up. I want to highlight one paragraph from that Fortune article. Here's what it says. After Amazon gave a not so good outlook about the economy in July, everybody thought that things would be better now. It says, quote, I think people were hoping that this quarter would be the bottom, and now it doesn't seem like that's the case because some of the challenges that they laid out in the summertime of 2021 didn't get worse, but they didn't get much better either. So Amazon, like other retailers and companies, came out in the summertime of 2021 and they said that yeah, things have been booming up until now, but we're kind of worried about the future because we're starting to see things slow down. And then everybody assumed that this would be better by the end of September or at least by October of 2021. And now Amazon's coming out again in October of 2021 saying, yeah, things are not getting better and we don't know when they're going to get better yet. Our economy runs on spending. If I take $100 and I go to your restaurant and I buy a nice meal, well, now I spent my hard-earned money at your restaurant. You made $100 and now you can take this $100 and reinvest it back into your company. You can use this money along with everybody else's to open a new store. You can hire more employees. You can invest in more options on your menu. And so now if I spend money in your restaurant, you have money to grow, expand, hire more employees, and grow the economy. If I don't spend money, either because I'm worried about the economy or because I don't have any money to spend, now you don't make that money, and if people are not spending at your restaurant, now you don't have the ability to open a new store and hire more employees, and you might even have to let some of your employees go. This is something you have to pay attention to if you're investing your money, especially in the stock market, because if you're investing your money in the stock market, you're investing in the future growth of the economy, and if the economy is not growing fast enough, that's not so good news for the stock market, which is why, again, you need to understand what's going on, that way you can make smarter decisions with your money. But that also means that you need to be aware of what your goal is in the stock market, because if you're investing for the long term, you need to remember what your goal is, that way you don't overpay, and that way you don't panic sell, and that way you don't buy based off of greed. You need to know what your goal is, you need to know what your strategy is, and based off of that, you need to know how to analyze the right companies, or you need to know how to invest, because if you're not interested in trying to analyze and find the right company, then you need to know which ETFs to invest in, because that is a more passive way for you to invest without having to try to pick the best stock. Now, before I jump into number 3, if you are interested in learning more about how to invest your money in the stock market, our team put together an amazing guide that will walk you through how how to invest your money in the stock market. You'll learn about what stock market investing is, how to find the different stock market strategies, and some of the things that you need to know. That way you can be a profitable stock market investor, not a stock market trader. So if you want to know how to invest your money in the stock market and you want to read our free guide, I'll put the link to how you can download this guide in the description below. And the third thing that you got to pay attention to, which can bring the stock market down, is if people run out of money. Stocks, just like every other asset class, run on supply and demand. When you have more buyers than sellers, this pushes stock prices up. So if you have a lot of people that want to buy the Tesla stock, then this would push the Tesla stock price up, because now when you're selling the stock, you might have 10 buyers trying to buy your stock. And this will help you push the stock price up, because now you can sell your stock for a higher price. But you also see the flip side, because now if you have more sellers than buyers, you have a stock of a company which is now on the verge of bankruptcy. You're not going to have that many buyers. And so this is what brings the price of stocks down, because now you're going to be forced to compete against the other sellers to get a buyer. So now you might be cutting your price to sell your stock, and this is what brings prices of stocks down. So when you have more buyers and sellers, stock prices go up. When you have more sellers than buyers, stock prices go down. Anytime you see a point where investors are fully invested, well, this is good, because now that means the stock market has risen a lot, because a lot of people have put their money into the market, and they have put all their money in the market, which has helped stock prices to go up. But now you don't have any more buyers left, because everyone's money is in the market. And so now if someone tries to sell their stock, they're going to realize that there's no more buyers left, and they're going to have to cut their prices to incentivize somebody else to come in and buy these stocks. There's a couple ways that you can figure this out. First, you can actually just go and look and see how invested people are. In the middle part of 2020, we saw investors sitting on the biggest piles of cash ever. That means you had all this cash sitting on the sideline waiting to be invested, which is one of the reasons why you saw the stock market essentially go straight up from mid-2020 until the later part of 2021, because now investors started to come back into the market, and you had so much cash sitting on the sideline. It got a lot better in 2021, but you still have a lot of investors that are sitting on cash, which means you still have a lot of potential buyers that are just waiting there for the right opportunities, which will mean that if stock prices come down a little bit, these buyers will come in, which could help stock prices go up even more. And then you can also look at interest rates, because if you are a person or an institution and you can borrow money very cheaply, well, now you have easy access to cash, which then you can take and put right back into the market. But if interest rates start to go up, now all of a sudden it's more expensive for you to borrow money, because let's just say that you can borrow money at 3% right now, and then later on you'd have to borrow money at 5%. Now that means that you need to get a better return on your money for it to make sense and justify you borrowing money. But when interest rates are dirt cheap, now you can get a very low return on your money and still be profitable. So right now we have historically low interest rates. It's a little bit higher than it was in the middle part of 2021, but they are still historically low. That means you have people and institutions borrowing money and putting this money into the market, which is bringing more buyers into the market. But if we start to see interest rates go up, which eventually you would think that they will, but when interest rates start to go up, that would make borrowing money more expensive, which would make it less likely for people to now go out and borrow money and put this money in the market, because now you're going to need a better return on your money. And if the economy is not growing that fast, then you're not going to think that you're going to get that same higher return to justify borrowing this money, which could bring less buyers to the table. Plus, one day when the Federal Reserve Bank stops their asset purchases, that would also be another $120 billion or so that are entering the markets every single month. I gotta make these videos not to alarm you, but to educate you. That way you understand the different factors that you need to pay attention to. That way, if things start to slow down, you're not caught by surprise. You expect it. That way you can make smarter decisions with your money. If you enjoyed what you saw so far, then you're gonna love this. If you have an extra $1,000 and you put this money in the stock market, the whole idea is that you can turn your $1,000 into something a whole lot bigger. Because the alternative, if you don't put this money in the stock market or invest it somewhere, then you can just leave this money in the bank and see it do nothing and get eaten away by inflation. Or you can use this money to go out and buy some extra guac, which feels good for about 15 minutes, but then that money is gonna be gone. My goal is not to sit here and tell you what stock to throw your money in or what ETF to throw your money in. My goal is to educate you. That way you understand the different ways that you can put your money in the stock market. That way you can make an educated decision on how you invest your money in the stock market, because what's a good investment for one person might not be a good investment for you. That's why investing has risks. You want to make sure you always do your own due diligence and make sure you never blindly listen to a random guy on YouTube. There are two kind of general high-level strategies when it comes to putting your money in the stock market. There's the active way and there's the passive way. This is what Warren Buffett does, long-term investing. Active is more kind of your stock market trading, so you can make more money quickly. The whole idea behind actively trading your money in the stock market is you are going to hold on to your stocks for less than a year, and your goal is to make money relatively quickly. In this case, you're going to be paying attention to stock charts and maybe some stock fundamentals as well. So stock charts are when you see those crazy candles, those crazy charts where you see things going like this all the time. And so you're going to be looking for what kind of indicators there are to show you that a stock might be going up very soon. If you see an indicator, because there's a whole lot of different indicators, like we're talking about hundreds, if not thousands of different indicators that people can look at to kind of indicate what they think is going to push a stock price up. But you're going to want to pay attention to just a few. I'll talk about that in just a second. But once you find these indications that indicate to you that a certain stock is going to go up, that's when you want to come in and buy, and then you want to sell relatively quickly when you hit your sell target. This is an active way to trade your money in the stock market, because if you want to do this type of stock market trading, you're going to have to pay attention to stock charts, and you're going to have to pay attention to the stock price pretty often. And so this isn't something where you can just throw your money in the stock market and never look at it. You got to pay attention, because your goal is to make money relatively quickly, so you got to be actively involved. And this could mean a few hours a week or a few hours a day or full time, depending on how much money you have and how actively involved you want to be. There are countless different ways to make money as an active trader in the stock market. Now, personally, I am not an active trader. I am a passive investor, but that doesn't mean that active trading is wrong. This is a way for you to make money relatively quickly, and then when you make this money, if you want to keep this money and grow long-term wealth, that's when you want to do passive investing. We'll talk about this a little bit later in this video, but let's focus on some of the different active trading strategies. So one strategy is by trading momentum. Momentum means that you're going to find a stock that's going up, and you assume that because the stock is going up, it is going to continue going up, at least in the short term, and so that's when you want to come in and buy. So you're going to be paying attention to stock charts and seeing what's been going up quickly, because if something's going up quickly, then that kind of indicates that there's going to be a lot more news coming out, a lot more press coming out, and if that happens, people are going to get excited and sentimental, and they're going to want to come in and buy more, and before that happens, you want to come in and buy as a momentum trader. Growth stock strategy is when you're looking for a company and you're looking at two things. You're going to be looking at the technicals and you're going to be looking at the fundamentals. So the technicals are what I'm going to be talking about in just a second when you're looking at the stock charts. So you're going to be looking for a breakout. So kind of like here, you're looking for momentum, right? That's one of the indicators here. You're looking for a stock price growing pretty quickly. That's one of the indicators. You're going to have different indicators here on the technical side of things, but you're also going to look at fundamentals. Here you're looking for a growth company. So these are kind of your smaller startup type companies, and so you're going to want to see revenues growing by 20% a year. And so if you're seeing companies growing, they're a growth company, and if they have kind of that breakout indication, then this might be a good trade for you. Essentially, when you're following this growth stock strategy, you are doing kind of a mix of fundamental analysis, long-term investing analysis, with this kind of technical analysis where you're just looking at stock charts. Because now when you make a trade based on technicals, it also has to be a strong company fundamentally. So you're looking for a company that's about to break out, that you think because of the charts, but you're also only going to invest in this company or put your money in this company if it has solid fundamentals, if it has been growing quickly because you want to be a growth stock, and if it has seen growing profits, and if it has good potential in the future. So this is a little bit less risky than some of the others, because now you're combining the fundamental and the technical. But in order for you to make money here, you're going to probably be holding on to a stock for at least a few months. Day trading is another one. This is where you're buying and selling stocks every single day, and so now you're looking to make smaller profits per trade, but you're going to make in a whole bunch of trades. So if a company goes up by just a few cents, that might mean enough profit for you to come in and sell. So day trading is now a very short type of trading where you're going to be looking at certain indicators. Again, which indicator are you looking at is going to depend on your strategy, but you're going to be looking at certain indicators that say, oh, because this just happened, I think this stock is going to go up, so you're going to come in and buy, and once you hit your sell target price, that's where you're going to sell. You have swing trading. Swing trading is similar to momentum trading, but still different, because now you're going to have different indicators that tell you that you're hitting a breakout point or that you're hitting resistance. And once you hit those two things, you're going to be buying or selling. And so you're kind of just watching the stock go like this. And so you're going to swing between a low and a high, and you're going to buy it at the low, sell it at the high. And then we have gambling. This is what a lot of people do, even though they think they're doing something else, or they think that they're doing this, where they just throw their money in the stock market because they see everybody else doing it. They see people talking about the next hot cryptocurrency. They see people talking about the next hot stock. And so they just throw their money in there with no strategy, no game plan. All they want to do is get rich quick. I do not advocate you do this one. Now the question is, how do you know something is going to go up? So again, this is like what I've been talking about. You have to look at certain indicators. One way that you can do that is just by going to something like stockcharts.com and trend a company that you want to understand. So you can go there and type in Amazon, and then it's going to pull up the Amazon stock chart. And if you go down, you'll see a certain kind of drop down that says indicators. And you're going to see there's dozens of different indicators that you can pick from under the free plan. And here you can pick what indicator you want to look at. And so you have to kind of decide what indicators you want, because there are so many different indicators out there. One of the most common indicators of a trend is your moving average. So a moving average essentially just tells you that over a certain period of time, so you have 50-day moving averages, 100-day moving averages, 200-day moving averages. So over that certain period of time, what kind of general trend or direction is the stock moving? And so some people look at this as an indicator of momentum or kind of trends in the stock, because if they see a moving average start to turn around, that might mean that the stock is going to go up. So that's something that one person might pay attention to. Another very basic one that people like to look at is volume. Volume essentially says how many people are buying and selling this stock. And sometimes people will say, if you see a huge insurge of volume, if you have a whole bunch of people buying this stock or selling the stock, then that's an indicator of potential more momentum, because you have a lot of people coming in to buy this stock. And so you have to kind of figure out which indicator is right for you, because there are a ton of different indicators out there. But what you want to also understand is, once you kind of figure out what's right, you want to stick to your strategy, because a lot of times what happens, especially with newer traders, is you pick a couple of indicators that you like, and then these indicators will tell you to buy, but then you look at a different indicator that will tell you to sell, and then you shift your strategy, and so nothing starts to make sense. So you have to understand what your strategy is, and if you're going to be a trader, you got to understand how to stick with it, which is why psychology is such a big part of trading that a lot of people kind of miss, because they don't realize that there's a big emotional component when it comes to trading your money in the stock market if you want to do it successfully. If you cannot control your emotions, meaning if you get greedy when things start to go up and then you don't sell when you hit your sell target, or you start to panic when things go down and then you sell early, or you don't sell when you hit your sell target, then maybe this active trading is not for you. So now if you have $1,000 and you want to actively trade this money, you could take all $1,000, put it into one stock, and hope that this one stock is going to pop and make you a lot of money very quickly. This is a high risk, high potential reward way, but it comes with a lot of risk, because now if that stock goes down, you're going to lose a big chunk of your money. If you only have $1,000 to invest, then I would come in with much smaller chunks. Come in with $100 trades or maybe $200 trades. That way you can kind of test the waters and understand how things work, because what you're going to realize is that these indicators are not 100% right. They're not always accurate. I mean, you can be smart and still lose money in the stock market. And so you kind of have to start to learn and test the waters. And so before you just come in and throw all of your money into one thing, start testing it. Maybe you have 5 stocks or 10 stocks, split $100 each. That way you can understand how to read indicators, and you can start to see patterns, because it's going to take time for you to learn how to do something right and good. The last thing that I want to mention here on the active side of things before we go over to the passive is that if you want to be a successful active trader, I kind of hinted at this before, you have to have your sell target in before you come in and buy. So you got to know that if you come in and buy the stock at $100 a share, how much does it have to go up by before you sell? Or how much does it have to go down by before you sell? So you want to have your risk parameters in. Maybe you tell yourself that if this stock falls by 10%, you are going to sell. Sure, maybe it's a good trade, but it's not going to follow your strategy for you to ride the stock down and then wait for it to come back up, because you're a trader. So you want to be able to make these trades quickly, and you want to cut your losses quickly before they get bigger. So you got to know, okay, if it falls 10%, I'm going to sell. Or if it goes up 50%, I'm going to sell. You want to have both of these parameters in place before you come in and buy. Passive investing is different. When you are a passive investor, these stock charts don't really mean much, because when you are a passive investor, you're investing for the long term, and the thing that you're paying attention to is value. What you want to do as a passive long-term investor is either you can invest in ETFs and not worry about it at all. Or if you want to be a little bit more involved, what you want to do is you want to find a company that is undervalued, buy it, and hold on to it for forever, essentially. So I guess passive might not be the perfect word for it. It's more of a long-term investor, because as a long-term investor, you have a passive strategy and then a little bit less passive strategy. Let's start with a little bit less passive strategy, where now you want to find a company to invest in and you want to find an undervalued company. When you do that, the things that you're going to pay attention to are fundamental. When I say fundamental, I mean not technical, right? Technical means the stock charts. Fundamental means things within the company itself. So you're going to be looking at a company's revenues. You're going to be looking at a company's profits. You're going to be looking at a company's expenses. You're going to be looking at a company's moat, and you're going to be looking at a company's executive structure. And then finally, you're going to be looking at what potential market opportunities this company has in the future. There's a couple ways that you can find this information. You can go directly to a company's website and scroll down to the investors relations section. And when you go there, they're going to have their quarterly reports and their annual reports. And if you just click one of those, it will show you all of this information. Or you can go to a stock data website and look at this information over there. There's a ton of these websites on the internet. So now, when you're looking for a company that's undervalued, the first things you're going to look at is how much money is this company making? This is the revenue. And you're going to want to see, okay, are the revenues growing or have they been shrinking? If a company's revenues have been shrinking, that's probably not a good sign. Then you can pay attention to the profits, because revenue is just how much money this company brings in, and the profit is how much money they keep. And so you want to see, are their profits growing? Do they have more profit potential in the future? Or are their profits shrinking? And if their profits are shrinking, why are they shrinking? Because if their profits are shrinking just because their expenses or the costs of doing business are going up, that's not good. But if their profits are shrinking because they're investing more heavily in their business to make more money in the future, that's a good sign. And that could mean a great opportunity for you. And the way you figure that out, what their expenses are, is you're going to actually read these reports, and these reports will tell you where their expenses are. Because if you see these expenses increasing in investments into the company, if they're hiring more people, if they're doing more kind of capital expenses into whatever they're doing, then that might be a good sign. But if you're just seeing the cost of business going up because their material costs keep going up, then that's not a good sign. So your revenue, your expenses, and your profits are going to give you an idea of a company's numbers. The next thing you want to pay attention to is the company's moat. A moat is how difficult is it for another company to come in and take your company's spot. And so a moat is essentially, is there a lot of barrier to entry or no? Because if there's no barrier to entry, then it's not very hard for another company to come in and take your company's spot, which might not be a good long-term investment for you. That's one of the things that Warren Buffett loves talking about, is how big a company's moat is. Because he wants to invest in companies that have a big moat, because if it's very hard for another company to come and compete, then this company can be around for a long, long time because they have a high barrier to entry. It's hard for another company to come in and compete with them. Now, there's not a real number that you can put on this. This is something that you're going to have to do your own analysis with. Like if you look at t-shirt companies or teen clothing companies, American Apparel and Abercrombie, what does it take for another company to take their spot? Not a whole lot. I mean, yeah, you have to have the right clothing, and these clothings change all the time. But now, how do you build that trust with another teenager? These things can change because you have a new generation of teenagers constantly coming in. And so it's not too hard. You don't have that major barrier to entry as opposed to something like Visa. Visa has a higher barrier to entry because Visa has contracts with merchants and sellers across the world. So now if you want to create a new credit card company, then you're going to have to go to every merchant across the world, and you are going to have them kick out Visa and take your credit card. That's not very easy to do. Then you can take a look at a company's executive structure. One reason why people loved investing in Amazon before was because people loved Jeff Bezos. Now, Jeff Bezos, at the time we were recording this video, was no longer the CEO of Amazon, but people really liked that. And so you can study the executive structure. Who is the CEO? Maybe they have a book. Maybe they have some biographies out there. If you do some searching on them, you can see what kind of person are they? How much passion do they have for your industry? What creativity do they have? And so you can look at this executive structure and see, is this a good person to lead the company? If so, then that's a good thing for a long-term investment. And finally, you can look at the future market potential of this company. So one of the things that's been really hot in the tech space is building an ecosystem, right? Like Apple wants to build an ecosystem where everything you do is Apple. You want to have an Apple phone, an Apple Watch, an Apple iPad, an Apple TV, maybe an Apple car. And so you're building this Apple ecosystem where everything that you have tech related is Apple, and they all communicate with one another. And so that could create more market potential in the future, because not only are there more products potentially, but there's also that kind of monthly subscription model in the future. And so if you kind of build out this ecosystem, that's something that can create long-term value for the future. And so these are the type of questions you want to be asking yourself if you want to be a fundamental investor, a long-term investor, and you want to find the companies yourself, and you like the idea of paying attention to earnings calls. These happen typically every quarter, meaning 3 months. And so if you like the idea of keeping up with a company and doing this research, then that's one thing that you can do. If you want to invest your money in the stock market and you hate the idea of reading earnings reports, you hate the idea of reading numbers, you hate the idea of keeping up with companies, but you still want to see your money grow, then instead of looking for these undervalued companies, what you can be investing in are ETFs. So an ETF stands for an exchange traded fund, and essentially an ETF is just a group or basket of stocks. So now instead of you trying to find the best stock to invest in, you can invest in an ETF like VOO or SPY. Now I'm not telling you what to invest in, just an example, but VOO and SPY give you exposure to the top 500 companies in the stock market. So if you go out and you buy shares of these ETFs, you're essentially getting exposure to now 500 companies. You have ETFs for every sector. You have tech ETFs, you have healthcare ETFs, you have real estate ETFs. And so now you just got to figure out, do you want to be here or do you want to be here? If you want to invest in ETFs, the way to be a successful ETF investor is to now invest for the long term. Anytime you get paid, you're going to take a portion of your paycheck and you're just going to automatically put it into these ETFs. So if you have $1,000, if you have 2 ETFs that you want to invest in, you just split it 50-50. And so the whole idea here is it is completely passive. You're going to invest in these ETFs for the long term. Whether these things go up or they go down, you're just going to keep putting your money into them, because the whole idea here is you are betting on the long-term health and growth of the stock market. We have seen the stock market grow for the last 100 years, and if you continue to believe that the stock market is going to continue to grow and our economy is going to continue to grow for the next 3 decades, then you want to just keep putting your money in ETFs no matter what. Every 2 weeks, every month, whatever your cadence is, you're just going to keep throwing your money into these ETFs. Here, if you're looking for undervalued companies, then what you're going to be doing is you're going to look at the numbers and then you're going to say, okay, this company I think is worth $5 billion based off of my analysis, right? So you're going to look at the numbers, the revenues, the profits, and based off of that, you're going to come up with a number. Now, if this company is trading for $4 billion, that's when you're going to come in and buy. Now, again, if you just have $1,000 and you want to be diversified and you want to protect yourself because you're a newer investor, then don't put all $1,000 into one company, especially if this is your first time. Now, you can try a few different stocks and divide it up 250, 250, 250, 250, or kind of figure out your own cadence depending on what stocks you like. But you got to understand that the more money you put in, the more money that you can make over the long term. And as you make more money, then you can reinvest this money back into the stock market. These random monkeys who are throwing darts blindfolded at these financial newspapers and financial stocks, he thought that over the long run, these monkeys would be able to beat the average person. And he actually thought that they would be able to do just as good as the experts. Well, this Princeton professor was wrong. Not only did the monkeys beat the ordinary people, but they also beat the experts.